So last week we did a stream about what is trading and how do we make this trading decision, but we had a technical problem. So the stream was there was no sound for half the stream. So this week we are gonna do it again, but this time with the sound. I've double checked. Normally now there's the sound. So everything good. So I'm delighted to be here with you today, and if you have any question, please feel free. So this stream will be organized in several parts. The first part will be basically a basic dive into trading. What is it? How does it work? What are some of the vocabulary you might need to know if you're interested in trading and want to do a training, or just if you want to learn trading, there's some vocabulary and it can be a bit daunting. So this is one part we're going to do today. Then afterward we are going to talk about fundamental analysis. What is it? How do we do it? Why do we do it and why it's important? Then we are going to have a quick dive into technical analysis. Check. Then we're going to talk a bit about the different trading strategies, and also the difference between trading and investing, because there are two different things, so you need to know which one is made for you. Maybe you're just interested in investing and not in trading, so there are two different things, so you might want to know the difference between them. And finally, the risk management and psychology of trading, because those are two important parts. And in the end we're gonna do a quick Q&A question if you have any question, and after that normally we should be around the 1 hour mark, and this should mark the end of this live stream. So let's start with basically what is trading. Trading is the act of buying and selling a financial asset on the financial market. Classic shit. It's on financial asset, buying and selling financial asset on the financial market. So, and the goal is to buy low and sell high in order to make a profit. Okay. So basically, that's basically what a trader do. He look at the price of financial assets and decide when he wants to buy them or if he wants to sell them, depending on if he think they're gonna go down or they're gonna go up. So this is the main two action a trader can take. He can take a long position or a short position. What we call a short position is when somebody is selling the asset and then buying it afterward at a lower price in the hope of making a profit. In order to be able to do that, because he's selling an asset he doesn't own, he's borrowing it to his broker or financial institution or anything, then selling it on the market, then waiting for the price to drop, and then he's buying it back at lower price, then give it back to his broker or to the person who loaned it to him. In order to, basically, if for the trader they sold an asset they didn't have, they borrowed to someone and bought it afterward, so they're basically neutral, they don't have anything left. Meanwhile, for the person who lent the asset, they have the asset at the beginning of the operation and they get it back at the end, so it's neutral for both of them. A long position, it's easier. It's basically you buy something, hope the price is gonna go up, wait for the price to go up, and once the price has gone up, sell it. So this is basically the very fundamental of trading. That's what traders do. On the other hand, people who are investing generally tend to buy an asset and hold it for a long time. They don't they don't take short positions. They just basically buy an asset and wait for it to gain value over time. So that's the main difference between the two between trading and investing. Then afterward, now we're going to talk about the different type of financial market. We can basically summarize the financial market in five big class of financial assets. So there's the stock or equities. That's the most famous one. When you think financial markets, that's what everybody has in mind, is stock. Then so that's the main most known one, but it's one of the actually smallest one in terms of volume. So money exchange, trade and money exchanged every day. Then there's forex, which is basically a currency market, which is either the first or the second most important financial market in the world. There's it depends of the period, but mostly I think it's something like 7 billion. Yeah, billion of transaction. No, not billion, trillion of transaction. Trillion of transaction daily. So that's quite a huge amount of capital that is exchanged on the forex market. So this is one of the biggest. This is the biggest financial market, or fighting with also bonds. The bond market. The bonds are basically the debt market. So when a government or a company are borrowing money, what they do is they issue bonds, and people buy those bonds. So they give money to the company, and at the end the company or the government pay back the bondholder with the amount they pay at the beginning plus the interest. This is with forex. This is the biggest market. Depending on the year and the period, it goes from 5 to 10 trillion of dollar exchanged every day. So that's very there's a lot of money circulating on the bond market. Then afterwards there's the commodities market. So this is a market for oil, gas, agricultural product, energy, metals and everything. And this is mostly used either to speculate, but it's maybe 10% of all the exchange, but mostly it's used as insurance for real for what to say it in not brokers, but trade for companies that sell those products physically. Like for example, if you're a mining company, you may want to buy a financial asset linked to commodities in order to have insurance over the fluctuation of the price. And therefore you're gonna enter position on the financial market to protect yourself from those set fluctuation. So in order to take part in the financial market, you're gonna need to use something called a broker. A broker is an intermediary. Basically, an intermediary that it's a licensed profession. So you need it's mandatory to use a broker if you want to enter financial market, because otherwise you're not the same as doctor or lawyer. You need to it's mandatory to use a broker. And then the second one, and basically what they do is they basically pass the orders you send them to the financial market, so that the financial market can so you can buy or sell, and they execute the order you send them. If you want to be a retail investor, you're going to need to use also what's called a trading platform. Here, that's what you see on my screen. On my screen is Atas trading platform. It's a Latvian trading platform that we partner with at Paris Trading Academy. And basically for us it's very convenient, and also it's it's easily like you can personalize it the way you want it. So it's in our opinion, it's at Paris and Dubai Trading Academy. It's a very good platform. Then also there's a few vocabulary you might need to know. So there's like the what we call ticks. So ticks are actually several things, but to us, to the financial market, mostly ticks is a transaction is a tick. So it's every time the market server refresh. So I believe it's like legally capped at 1 millisecond, but I'm not completely sure about that. It might need I might need to verify what I say. And then there's also leverage. That is also quite important, especially when we are like us, you're trading future. That is another thing. So basically, leverage is when you're buying contract some financial asset that costs more than the amount of money you have deposited to your broker account. So basically, you're borrowing money to your broker in order to be able to buy expensive financial asset that you couldn't buy without those funds that you borrowed from your broker. So leverage is interesting and at the same time dangerous, because basically it allows you to increase the amount of your gain, your possible profits, because basically, since you're borrowing money, you're able to take bigger position size than what you would be able to do with only your capital. Therefore, you can you have the ability to increase your profit. At the same time, it also increases your risk, because it basically increases if you're losing, you can lose more money, and basically you can wipe an account even though the financial asset you bought value didn't reach up until zero. So when you're trading with leverage, it's very important to have a very sound and solid risk management strategy. So when you're trading with leverage, another thing that's important to know is margin. Margin is basically the amount of capital you need to have in order to take the position you're having. And when that margin reaches zero, your broker can do what's called a margin call, which would then where they would ask you to put more money in your account, or they're gonna close your position and you're gonna lose all your money. Another key terminology, another thing that's important to know, especially in our case, because we're trading future on indexes. So the first thing you need to know is what is an index. Basically, an index is a mathematical average that tracks a group of stock depending several criteria. The biggest one is S&P 500, and it's one of the oldest one is Dow Jones Industrial Average that was created in the 19th century. Then there's the S&P 500, which is basically the 500 biggest American companies that are listed on the New York Stock Exchange. There's also the Nasdaq, which is at the same time a marketplace in New York, and also two indexes. There's the Nasdaq 100 and the Nasdaq Composite. So the Nasdaq Composite is an index composed of every company listed on the Nasdaq Stock Exchange, and the Nasdaq 100 is the 100 company that has the biggest growth. That's the biggest growth. And then future are basically an agreement to buy and sell or sell, depending on if you buy the future or if you sell it, that at a future date. So and it's the size and of the contract as well as the expiration date, the date where you need to buy or sell the asset are standardized, and future are traded on organized market, such as the CME, for example, or in France it would be the Eurex. Eurex en français. So we in Paris Academy are specialized in the future on index trading on European and American index for several reasons, but mostly it's because of the leverage and the volatility of those assets. The volatility of an asset is basically the speed at which it's moving. Price is moving, and it's the range of movement the price can have. So example, if you look on the left, the Nasdaq here, that you see the future on Nasdaq here, is extremely volatile, and way more than, for example, the S&P 500, which is still quite volatile compared to different assets such as Forex, for example. So basically, trading is that. So in Paris Academy, we are specialized also in we are going to buy and sell like future on index on a very short time frame, and that is called scalping. But we are going to talk about that later. So in order to know if we need to buy or if we want to buy or sell the asset, we have a pretty strict decision-making process, which basically rely on two main elements. And those two elements are fundamental analysis as well as technical analysis. So we're going to start by talking about fundamental analysis. So fundamental analysis, it's basically the study of every fundamental factor that would possibly move the market. So if you look at a company, you're going to look at their financial ratios, their result, their place in their market, how is their competition. You're going to look at basically any fundamental element in there, like to see if the price of the stock is going to move or is going to to value the price of the stock. If you look, for example, at Forex and currency, you're going to be looking at all the different economical statistics of a country to try to identify if the economy is strong or on the opposite if it's not. If it's weak, what are their weakness, how are they in which direction the economical statistics are moving, do you think what decision the central bank are going to take. There's a list of factors that you're going to look at to try to identify the trend of those currency pair. If you look at, for example, commodities, you're going to look at the global demand, and the use of that commodity. Is the demand going to increase, decrease? Is the supply increasing, decreasing? Is there something that weight on the supply that's gonna make it diminish, or if it's on demand, or anything that may have an influence on price. To us on index, how to do when we do a fundamental analysis, basically what we're gonna do is we're gonna look at every of the economic news, because the index are unanimously used as an indicator of the economic state of a country. For example, if you take the S&P 500, since it's the 500 biggest economy, a company in the US, if the S&P 500 is doing good, we can assume that the US economy is normally going pretty good. If the US economy is going bad, then it should reflect on the S&P 500 and on its value. So that's how we do our fundamental analysis. We open like economic news website, such as, for example, here, Investing, and we're gonna look at the news and basically any information we can find to try to see how we can how basically the news are gonna reflect on the indexes. Also, we're gonna look at the economic calendar because basically, as you can see, there's a lot of economical statistic published that generally on which the market's gonna respond, and also it's gonna provide us with information on the economy and also on the bank central policy. So it's gonna give us in general some information about where the market is gonna move. If the statistics are good inside the economical context in which we are, then probably the market should go up, and otherwise if it's bad, it should go down. It's not always true. You need to always put everything back into perspective, figure out and try to anticipate how the market's gonna react to that, how the market and its participants are gonna react to those numbers. So this is more or less how we do our fundamental analysis. We also tend to look at all of the all of the different class of assets, and try to anticipate, like to see how they are moving, because since the financial market in whole are all since we live in, it's a complex system where everything is correlated, so we can in general anticipate, like by looking at how the the different class of assets are working, we can anticipate the future move of other financial assets. The same way also, depending on the geographic area, if the Europe is deeply in the red, it's we can anticipate that the US might be, or the opposite, depending on the time. Basically, most of the financial assets are correlated, so by looking at the way the different asset class are moving on the market, we can anticipate how the asset class that interests us is gonna move. Then once we've done that, in general, it's gonna give us direction we will prefer to take trade for the day. So basically, if we look at the economy, like if every of the news is good, every asset's been in the green, there's a high probability that the assets that interest us is gonna go up. At the opposite, if it's the war and the end of the world on the outside, like everywhere in the world, most likely every asset's gonna go down. So if we have basically more, if the news are good, we're gonna try to buy, and which means we are bullish. Bullish is a term that we use to say that we think the market's gonna go up. If we think the market's gonna go down, there's something, we are then bearish from the bear, and that's like terminology. Hello. That's basically that's basic terminology. If you listen to any economic news or any economical news channel or read news, you're gonna encounter the term bullish or bearish or bull, bears, like very often they're like quite common, and that's the reason why there's like the raging bull in Wall Street. Him, because he's supposed to the charging bull, because he's supposed to push the market upward. So this is why this bull is here. Yeah, and it's in Wall Street, and it's one of the symbols of financial market. What do I think about the volume profile? Well, volume is important. It provides you with many different information, but yeah, it provides trader with many important information. We know that, for example, like first, when there's not enough volume, it's not something we're gonna trade. Then afterwards, it also provides us with the information, like it gives us the information to know if is the market balanced or not. So that then, like if the area of the market is balanced or not, so it can give us, it can tell us whether or not we should enter a trade or not, if it's an area of value that would make the trading interesting or not. It also can give us indication on whether it's going to break its resistance or support level. So yeah, volume is always important to look at. And then you're going to have to, depending on that, it should be something you take into consideration when you're trading. Because if there's no volume, trading is not really interesting, but sometimes if there's too much also, it can be unpredictable, so you need to be worried about that. So once, like I've talked about, like basically we do a fundamental analysis, so it's gonna basically give us our market direction for the day. Do we think the market is supposed to go up? Is it supposed to go down? And stuff like that. Once we've done that, we do like something called technical analysis. So technical analysis, it's basically the study of the graph. I'm opening a new one. And the price action, like the way the price move, and then once we done up, yeah, okay. So and then yeah, we're gonna look at the graphic and study the way the price move, and this will allow us to identify at which level we want to enter, at which level we want to exit, if do we want to enter there as an entry or an exit point, stuff like that. So yeah, I had already done that I think last week, but it's okay, I'm gonna do it again this time, like here. Why can't I dezoom? Okay, well. So, bla bla bla. Utiliser des objets, supprimer tout. Ah, ok. So basically, what we do is we look at historic data and then mark the level where there's like a support or a resistance. So what's the support? What's the resistance? A support, it's a price level where there's gonna be like a buying pressure, and therefore preventing the price from falling any lower. At the opposite, a resistance is gonna be a price level where like the asset is gonna encounter a lot of selling pressure. That's then gonna prevent the price from going above. If we look at the chart here, we can see, for example, that at this level there's like support. At somewhere here was a resistance that then became a support. Then, for example, here is a resistance. There was a resistance. Here is another one. Here is another one, and here is another one. when you're drawing your you need to also keep in mind that support resistance tend to be more area than precise price points. But in order for the graphic to be more clear and readable, we tend to use to mark them. We tend to use only line because otherwise the graph tends to be unreadable. Here is some kind of support and slash resistance. You see here it was a resistance. It then became a support, then we broke it then became a resistance, etc. In order to mark those levels, you always normally start with a long time frame because it's a way, because like that the longer the time frame, voilà, merci, that's why it was the longer the time frame you're using, the more the stronger are gonna be your resistance level. So for example, if we look here, there's one as well. But if you, there's also, like in reality, there's like a lot of levels like that tends to act as support or resistance. So the main point of the main objective is to be able to find those levels while maintaining a readable graph, because otherwise it's gonna be very hard to like your graph is gonna be unreadable. So like you see, well, I started on the 5 minute, but I could have started here on the 4 hour. So here you see I've marked a few resistance and support level. Then after that I go on 30 minutes time frame. You work in a funnel. You start on the longest time frame, then you slowly go into the smaller one in order to be more precise. But basically you start with the long time frame. You see here I've had like basically since I've done it like with I started a bit I was a bit too specific, but here for example I don't have any new one to add. Maybe I could add one somewhere there, but it doesn't what? Okay, let's put one more here. Then I go on the 5 minutes, and so if you work like I said in a funnel, you're gonna get like a good ratio between what price are like between too much between precise level and not precise level, and too much information, because that's the main objective, is to find the right balance. So I could put one somewhere there, but yeah, whatever. So we do that, and once we've done all that, in general we will have information like, okay, so this is a price that where the market is probably gonna do something, is probably gonna turn around, or stuff like that. Another element of financial analysis is what we call is the indicators. Let me first remove everything I did so we can look at the graph so it can be clearer. So I keep my graph and I'm gonna put it in 30 minutes, because like that it's gonna be like clear. So then another part is the use of what we call indicators. So the most famous one and most used one is the moving average. Either it's exponential, there's a ton of moving average. So basically what people use is they use like several, like one short term, one medium term. I'm gonna put this one in orange. So, and this one that is gonna be the long term, I'm gonna put it in blue. So if you look a bit closer, you can see I have 3 lines on my graph, and basically they're gonna like give me signal like okay, now the market's going up, now the market's going down, so I should buy here, sell there, etc., etc. Basically, it's when the short term is above the medium term and the long term, then it's a buy signal, and the other way and the opposite. It's quite common and it's pretty easy to figure out, but it's not very reliable. And on top of that, it tends to be lagging, depending on how you set it them, but it tends to be lagging. Meanwhile, they are gonna show you a movement while it's over. Not completely, but while it's too late. And sometimes, especially when you're doing scalping like us, it can be a bit. It's a bit like it's gonna cost you like some money. So we, in our case at Paris Trading Academy, we tend not to use them that much. Especially signals tend to be like not necessarily always reliable. If you look, for example, where was it? Yeah, it was there. Like you see, for example, here is the same signal that basically you would have sold at this price here, and the buy signal is just there, and therefore it's yeah, it's compared to the like it's a 3 day, like it takes 3 days, and it provides you with something like like you miss whole of the movement that you could have taken if you look at just the moving average. So that's like another one that people use is the relative RSI, relative strength index, or RSI. We see it here. Basically, it's an indicator that tells you if you need to buy, or that tell you when an asset is overbought or oversell, but it's not completely reliable, because basically it says the rule: if it's above 70 you need to sell, and it's below 30 you need to buy. But for example, if you sold here when we cross 70, you would have to wait up until here to win like not a lot of money. Meanwhile, you would have had a huge loss in the meantime, so that would have been a very expensive time for just a very small move, and on top of like a microscope, like a very tiny move, and on top of that you would have cried for like 4 days because you would have burned your account. So generally what people tend to say is that you need to have like several to use several indicators to get your to take your decision. So like it's in general between 2 and 5. So that's give you the same signal. Another one, for example, is Bollinger Band, which basically use moving average and the volatility to create channel, and depending on the way it's moving, it's gonna give you like bullish or bearish signal, but the same way it's not always reliable. So in general, like I said, we tend not to use them, but so a lot of people use them and have been profitable with it. So I'm not gonna say it doesn't work, I'm just saying that that's not what we're using. Voilà, I've done moving average, tout ça, j'ai fait ça, il y a le RSI, les bandes de Bollinger. There's also the MACD, that is the MACD, that is basically something like that tells you like okay, say like okay. So in red is the if the red is above the blue, you're supposed to sell. and if the blue is above the red, you're supposed to buy, and then this is gonna give you the strength of the signal. It's the same way, not completely reliable. So in Paris Trading Academy, we are not gonna really use them, but it doesn't mean that doesn't work. It tends to be more effective in swing trading than in scalping. And in Paris Trading Academy, that's what we do. We do scalping. J'ai fait le banc de Boulanger, le MACD, le RSI. I forgot one, but that is there's also another famous one is Ishimoku, no? Yeah, okay. It's Ishimoku, but apparently it's not there. So there's also the stochastic, which work kind of the same way as the RSI. It's gonna give you like, okay, here you need to sell, here you need to buy. Is the attack and sell, buy, sell. But once again, it's the same with all of the indicators. They tend to be lagging and not necessarily always reliable. So we can't really we're not really using them. So then let's talk about the popular trading strategy. So basically the first one is one of the most famous one is the swing trading. So basically you're gonna look at I forgot about that, at the market move and try to make profit following the trend. So like you see here, we are in an upward trend, the market's going up, so basically you will want to buy at the beginning of the trend and sell somewhere, here. On the for example, another example, you would want to sell somewhere here and buy back somewhere there. To summarize, that's basically swing trading. So you're gonna take position for a long period of time, maybe 2 weeks, 3 weeks, a month, stuff like that. Then there's day trading, where you're gonna try to profit from the move in one trading day. And then what we do in Paris Trading Academy is called scalping. So we're gonna take like a position for a short period of time, something like 30 minutes, 10, 15 minutes, maximum half an hour, basically. So scalping is interesting because since we're taking, we like scalping because since we're taking position for a short period of time, we can take great financial risk by have a big leverage and stuff like that, because we don't take the position, we don't hold our position for a long period of time, so we're less subject to market to unpredictable event in the market. Therefore we can take more risk than swing trading, but it also requires a lot of it's more difficult than swing trading, because it requires being since we're taking we're trying to make profit on moves, on the way the market moves. We have to be on the edge and following and very careful and following the market. So it tends to be quite tiring, and in general it's recognized a more difficult way of trading than swing trading. So then we've basically defined how we make our decisions. So then there's the next step before trading is something called risk management. because like I said, there's like a great risk to lose all our capital if we are making mistakes and making wrong decision. So it's important for us to have a very sound and solid risk management, because basically that's how you last in trading. It's by having good risk management. Otherwise, you're just gonna end up burning through your capital, and your experience in trading is just gonna last just as long as you're gonna have capital. Then once you won't have any capital, your experience in trading is gonna end with in a quite bitter way, if you want my in my honest opinion. So that's a crucial part of trading. So there are several tools in the way we do our risk management. So there's first the money management and the position sizing. So basically we're gonna define on each trade how much money we're willing to lose. Then we're gonna calculate the size of our position in order to risk at the maximum this amount of money. But before that, we need to define precisely where do we enter our trade, where do we exit it, and do we buy or do we sell. So to do that, first we've done our fundamental analysis. We know if we want to buy or sell, and then the technical analysis is going to give us level at which we will want to buy, at level at which we will want to sell, and level at which we want to put a stop loss because we think that our analysis is wrong. The stop loss are a crucial part of trading. When I was trained, I had one of my teachers had this sentence that actually quite resonated with me, is that when people trade without stop loss, you go on the other side and you watch them cry. Because if you don't trade without a stop loss, you will most likely get burned really bad. But at the same time, you need to define the proper level to set up your stop loss, because otherwise you've lost your trade even before you've entered it. So it's quite a tricky gymnastic, but that comes with practice and also with your analysis. So really the most important part about trading is to be able to do a good analysis by that. So then we've defined all that. What we generally do is write what we call a trade plan or scenario, depending on thing is we say, okay, so I want to buy at this price, sell at this price, put my stop loss at this price. Then once we have done that, we buy X contracts, X amount of contract. Once we know that, we are gonna basically do what we call we're gonna calculate the risk reward. So basically, it's how much we can win. It's the goal is to know how much we can. It's how much we can lose, divided by how much we can win. The goal is to get one that's inferior to 1. I tend to prefer to use to do it the other way, to do reward risk. Therefore, like if it's better than 2, it's good for me. But if you take it risk reward, it's then if it's lower than 0.5. Basically, which would basically mean that you would risk half what you can gain. And therefore, you should this should basically help you. If we do that, we then just need to wait for the market to reach the level we've already decided, and then at this point decide if we buy or sell. And if we follow rigorously these things, it prevents us to deal with the risk, the psychological risk of trading. Which is one of the main difficulties, because it can be extremely addictive, because it procurates a lot of emotion, and also provides you with a lot of adrenaline, and there's trading can be extremely addictive. So really, one of the discipline is something that's very important in trading. So if you have any question, feel free to ask them in the comment of in the comment. If not, I'm gonna continue with the conclusion. So basically, we've seen like what is trading, how we make our, what is our decision process, and what are basic and popular trading strategy. Also, we've quickly covered risk management. If you want more in-depth knowledge about those topics, well, feel free to contact us at Paris or Dubai Trading Academy. We're providing like training about trading on either 1 week, 2 week, or 5 week schedule, where basically we provide you with a complete tool of to get you started on your trading journey. And also, one thing that's key in trading is to know that you never know everything. Like once you know everything, like the only moment you know you have no more to learn about trading is when you're dead. Because it's, even though it's like it's not always moving, there's always more things you can learn, because like lots of very smart people are working on it every day, because it can be highly rewarding financially. So a lot of smart people really smart people are every day trying to find an edge on the market. So basically, you never know. It's impossible to know everything about trading. So you always need to learn, continue learning, and practice. Try to anticipate why the market is moving the way it's moving, and how you can be. Or you can do to be better, because it's always like you always need to improve. And also, like you should not consider trading as a casino or as a way to get an adrenaline rush, because basically the consequences is that you're gonna end up burning through your capital, risk everything, and it's not that it's not worth it. So thank you all for your presence and for staying with me during that stream. I will see you tomorrow in French for another stream about trading. I'm gonna decide this afternoon what's gonna be the topic tomorrow, but it's probably still gonna be educational, probably more about like macroeconomics, I think, because I feel like talking about macroeconomics. And thank you all. Don't hesitate to like and subscribe, turn the notification on. You've been on YouTube before, you know what to do, and thanks. See you tomorrow. Bye.